The 2008 financial crisis, when the world ran out of trust. In 2008, the world did not run out of money, but it did run out of trust. The collapse did not begin with explosions or dramatic headlines. Instead, it began quietly, as small problems inside the system were ignored. Lehman Brothers, a 158-year-old investment bank, collapsed in a single weekend, and what followed was not just a bankruptcy, but a shock that quickly spread through the global economy. After the dot-com crash and the tragedy of 9/11, Wall Street was still trying to recover, and in response, the Federal Reserve stepped in with a new approach. Interest rates were cut all the way down to zero, and borrowing suddenly became easier than ever before. When money is cheap, people borrow, and during this period, borrowing felt safe. People were optimistic because owning a home meant stability, status, and security, and for many, it represented the American dream. Buying houses spread rapidly across the country, including among people with no stable income, no savings, and little certainty they could repay their loans. Billboards reinforced the message everywhere: why rent when you can own? When people asked what would happen if they could not pay, the answer was simple and reassuring. The house could always be sold later at a higher price, because most people believed housing prices only moved in one direction: up. As lending standards loosened, new types of loans entered the market. Ninja loans, no income, no job, no assets, allowed people to borrow without traditional checks, while subprime mortgages expanded credit to borrowers with poor credit histories. These loans were riskier for banks, but they also carried higher interest rates, which meant higher profits. As long as housing prices kept rising, the risk seemed manageable. Many mortgages were designed to look affordable at first, with low initial payments that increased later. Few borrowers thought about future payments, because they expected to sell their homes before costs rose. From the bank's point of view, the loans still appeared safe. If borrowers failed to pay, the bank would simply take the house back. At this point, Wall Street pushed the process even further. Instead of keeping these risky loans, banks grouped thousands of mortgages together and sold them as new financial products. These products became known as collateralized debt obligations, or CDOs. The idea was straightforward. If risk could be spread across enough loans, someone would always be willing to buy it. And someone did. To reassure investors, banks turned to credit rating agencies. These agencies were paid by the same banks, whose products they were rating. As a result, many of these bundles received the highest possible rating, AAA. On paper, the risk disappeared. In reality, it was simply hidden. Some investors remained doubtful and asked what would happen if these assets failed. They were offered insurance, in the form of credit default swaps, which promised payment if the mortgages collapsed. What mattered most was this: even people who did not own the investments could buy this insurance and bet on failure. As profits grew and warnings were ignored, confidence slowly turned into false confidence. Money kept flowing, and as long as it did, few people questioned what was underneath. Eventually, the problems could no longer be ignored. Mortgage payments were missed. Foreclosures increased. More homes were put up for sale. Soon after, headlines appeared: home prices are falling. The system began to fall apart. Built on rising prices and borrowed money, it could not support itself once prices stopped rising. Mortgage-backed securities lost value rapidly, and assets once considered safe were revealed to be highly unstable. Losses spread quickly. Hedge funds collapsed. Investment banks reported massive losses. Trust between banks disappeared. In September 2008, Lehman Brothers failed. There was no bailout, no rescue. Its collapse sent a clear message across the world. If Lehman could fail, any institution could. Banks stopped lending to one another. Credit markets froze. The global economy began to slow sharply. Businesses struggled to pay workers. Investors could not access their money. Families fell behind on mortgages. Unemployment rose quickly. Millions of jobs were lost. Foreclosures increased, and eviction notices became common. While Wall Street fell apart, Main Street entered a free fall. The crisis spread beyond the United States. Major banks collapsed in Iceland. Markets fell across Europe, Asia, and South America. The financial system was global, and so were its failures. Faced with a full-scale collapse, the U.S. government had to decide. It could allow the system to fail, or it could step in using taxpayer money to prevent total economic breakdown. The government chose intervention. Through the Troubled Asset Relief Program, or TARP, hundreds of billions of dollars were sent into the financial system, based on the belief that some institutions were too important to fail. Insurance giant AIG was rescued after it proved unable to cover the guarantees it had sold, while major car manufacturers received support to prevent widespread job losses. Meanwhile, at the Federal Reserve, Ben Bernanke introduced emergency measures. To prevent a deeper collapse, interest rates were pushed to nearly zero, and a new policy was introduced. This policy was called Quantitative Easing. It involved creating new money and using it to buy financial assets directly, flooding markets with cash. The strategy worked in one sense. Markets stabilized. Banks recovered. Asset prices rose. Wall Street rebounded quickly. For many people, however, recovery was much slower. Jobs returned gradually. Wages lagged behind. Household wealth declined sharply. Millions continued to struggle. Those who had caused the collapse were rescued, while many ordinary families depended on government assistance. The difference was impossible to ignore. As frustration grew, people began asking a simple question: who was this system really designed to protect? In 2011, public anger led to protests near Wall Street, most visibly in Zuccotti Park. This movement became known as Occupy Wall Street. Its message was simple: we are the 99%. The protests were not just about banks or bailouts, but about a system where losses were shared by the public's profits went to the private sector, risk was rewarded, and accountability was rare. Quantitative easing saved the financial system, Occupy Wall Street asked. Who paid the price? The crisis eventually ended on paper, but its effects lasted for years. Wall Street recovered. Main Street adjusted. Trust, however, never fully returned. The crisis ended on paper, but the trust never fully returned. If this helped you understand the system more clearly, like the video and subscribe. Clear explanations of how the money system really works are coming.